There is a number sitting in your bank account right now that does not physically exist anywhere on Earth. Not in a vault, not in a drawer, not printed, not minted, not stored in any building you could walk into and touch. It is a line of text on a server, and yet you can use it to buy a car, a house, a life. Now here's the part that should bother you. The bank that gave you that number created it in about 4 seconds with a few clicks the day you signed your loan. No gold moved. No cash was counted. A number simply appeared where nothing existed before. If you did that, if you opened your own banking app and typed an extra zero into your balance, that is a felony? For a bank, it is Tuesday morning? So the question worth sitting with is not how do banks make money. Everyone thinks they know that one. The real question is why one entity in the economy gets to manufacture the very substance everyone else has to earn, borrow, or steal. This isn't ancient history. This is happening today on a scale most people can't picture. Total bank lending across the global economy runs into the hundreds of trillions of dollars, and a huge portion of that was never sitting in a vault waiting to be lent. It was created at the moment the loan was approved. Every mortgage, every business loan, every car payment plan adds new digital currency into the world that didn't exist an hour earlier. To understand how we got here, you have to go back to a much smaller, much shadier version of the same trick. In 17th century London, goldsmiths held people's gold for safekeeping and handed out paper receipts as proof. People started trading the receipts instead of digging up the actual gold. Convenient, except the goldsmiths noticed something. Almost nobody redeemed all their receipts at once, so they started printing more receipts. Then the gold they actually had sitting in the vault and lending those extra receipts out for interest. Nobody could tell a real receipt from an overprinted one. They looked identical. That quiet, almost accidental discovery that you can lend out more claims than you have actual assets is not a strange historical footnote. It is the operating system modern banking still runs on. Here's how it plays out today. Stripped of the jargon, you deposit $100. The bank keeps a small slice of it in reserve and lends out the rest. That borrower spends it, and it lands in someone else's bank account. That bank repeats the exact same move, keeps a slice, lends the rest. Round and round it goes. 100. Real dollars can ripple outward into several $100s of loans moving through the economy, all traceable back to a single original deposit. This is not fraud. It is not hidden in fine print. It has a polite technical name, fractional reserve banking, and it is taught in economics classes with the same calm tone you'd use to explain how rain forms. But strip away the vocabulary and look at what is actually happening. The money supply of an entire country grows, not because anyone built a factory, grew more wheat, or discovered new oil. It grows because a loan officer clicked approve. Here is the detail that changes how people see this once they actually understand it. When a bank issues you a loan, in most modern economies, it isn't shuffling money that already existed. It is creating a new deposit in your account out of nothing, at the exact moment your loan is approved. This isn't a fringe theory whispered on. Internet forums, central banks have published this openly, in their own reports, in their own words. So new debt equals new money. And when that debt gets repaid, the money is effectively erased again. The entire money supply is not a fixed pile sitting somewhere waiting to be divided up. It expands and contracts constantly, breathing in and out with how much debt is being created and destroyed. Money in a modern economy isn't really the thing of value credit is, and credit is just trust, wearing a suit and carrying a briefcase. Now put yourself back in the picture. If you want money, you have exactly 3 doors available to you. Work for it, borrow it from someone who already has it, or sell something you own to get it. Every single one of those paths requires the money to already exist somewhere else first. You are only ever allowed to move currency. You are never allowed to originate it. This is where the comfortable story falls apart. We are told banks are simply middlemen, safely storing our money and passing it to borrowers, like a library lending out books it already owns. The real story is less comforting. Banks are not primarily moving existing money around, they are manufacturing new currency and then charging you interest for decades to use the very money they invented on the spot. Sit with the shape of that deal for a second. You take out a $200,000 mortgage. That money did not exist in a vault waiting for you. It was created the moment you signed, and yet you will spend the next 25 years paying interest on money that took less physical effort to produce than the paperwork you signed for it. Nobody hides this. It's disguised, not hidden, wrapped in language dry enough that nobody bothers to ask what it actually means. Reserve ratios, monetary transmission, credit expansion, words engineered to sound too technical to question. Here's where the stakes climb. This power isn't spread evenly across society. It's inside a small number of institutions, operating under rules set by central banks that decide how open or closed the credit faucet stays. When that faucet opens wide, borrowing feels cheap, asset prices climb, and everyone feels richer, at least on paper. When it tightens, refinancing dries up overnight, and the same system that felt generous 12 months earlier suddenly feels merciless. Most people experience the results of this as unpredictable economic weather. A recession arrives, housing becomes unreachable, jobs vanish. Very few people trace it back to a decision made in a room they'll never see about how much new credit the system was allowed to create. And here's the quiet irony sitting underneath all of it. We treat inflation, the rising cost of everything you buy, like some unpredictable natural disaster, but a meaningful share of it traces directly back to this exact mechanism. New money and new credit entering circulation faster than new goods and services are being produced to absorb it. The same machine built to fund growth is also the machine quietly eroding the value of every dollar already sitting in your pocket. So take a step back. This was never just a story about banks bending the rules. It's a story about who gets to decide what money even is and who is permitted to create more of it. Governments lean on this system to fund spending without taxing every dollar directly. Banks lean on it to earn interest on currency they never needed to actually possess first, and the public leans on it every single day without realizing they're leaning on anything at all. Nearly every financial crisis in modern history traces back to the same root tension: too much credit created too quickly, followed by the uncomfortable discovery that not all of it can ever be repaid at once. The entire system survives on one quiet assumption that everyone won't ask for their money back on the same day. That's not a new idea. That's the goldsmith's trick, just wearing a much better suit. Which brings us back to where we started, except it should feel heavier now than it did 8 minutes ago. If money can be created from nothing by the institutions that control credit and erased just as easily the moment a loan is repaid, then what exactly are you working so hard for so many years to accumulate? Is it the thing of value itself? Or is it simply a story everyone has agreed to believe right up until the day enough people stop believing it at the same time?